Good morning, John. It's good to see you once again. It's been a busy week on the political front, particularly in the United States. I've spent a couple of days watching the Republican National Convention, and I must say it looks like they are very, very confident of a Trump victory. And I think that the markets seem to be pretty relaxed about that outcome. How do you see the trend in markets over the last week, and whether it aligns with the political events or whether it's more driven by a pretty good earnings season?
Well, I think earnings are fine in America. I think that's coming from the numbers which you're reporting on. I just make the point this time that last time Trump was elected, it was a surprise. This time, if he's elected, it won't be a surprise. And if we go back to 2016 on election day, the markets in America rallied quite strongly on the surprise that he would win. I would only suggest this time, if he wins, it'll be no surprise, and markets would have fully priced it in. So I think that's worth remembering if you are trying to trade the markets. And if you are trying to trade markets, good luck. I think we are seeing volatility, though, Paul, and we've seen it again overnight. Let's just reflect that markets have been very strong. The Australian market's being dragged up in the month of July so far. Over 3%. We'll probably give back a bit of that on Friday today. But I think that's where we are. Markets are fairly elevated, and we're waiting for news. America gets their news fairly quickly, as you know, with their quarterly updates, quarterly results. Australia will have to wait till August to start seeing the numbers come through. But I don't think there'll be many surprises in the Australian reporting season. But I guess we'll hand over to the investment team maybe to report on that in coming weeks.
Yeah, I just want to drill down into the implications of a potential Trump victory, because now the betting markets are saying there's, like a 2/3 probability that Trump wins. Whether it's a clean sweep across the House of Representatives and the Senate as well is another question. But certainly the Trump forces are feeling very confident. Some of the key differences between Trump and Biden are that Trump has promised to increase tariffs, particularly on China, so we can talk a little bit about that. But also he's got a focus on deregulation, which tends to be good for financial markets generally. And he's obviously far less supportive of the green transition and environmental protection. Are these the main factors that you see where Trump might differ from a Biden administration?
I'd say so. I don't think there's anything that you've said there. I think the economy in America is showing a lot of resilience against very high interest rates. Everything you said is correct. The only unknowns I think I would throw in there is the relationship between Treasury, Trump, and the Central Bank of America, and the management of monetary policy in America under a Trump regime. Now, the claims constantly that they are independent, I beg to differ. I think there's quite a lot of partisanship in America, and it trickles down into into the Central Bank of America. Just my view. I would say under a Trump regime, the interest rates would come down a lot quicker than they will under a Biden regime. And I think I can just point to the fact that I don't know why American interest rates, cash rates, are 5.5%. It's truly ridiculous given their inflation rate and their inflation trend lines, and they're now standing well above the rest of the world. So everything you said is correct, Paul. I won't dispute anything like that, but I would just throw in, well, what we need to understand is what the Central Bank of America is going to do, and I think the things they're going to do are lower interest rates. That should see a weakening of the US dollar, which normally would be inflationary, and if you start adding tariffs to that, then that's inflationary. So I'm just sort of sitting back and watching all of this. I think there's a lot of statements being made, prior to an election, and when the real people take control, the real bureaucracy or the people, the cabinet behind Trump takes control. And I think he's learned from the last time, you want to have good people behind you and listen to them. I know Trump's not a great listener, but I actually think it's just business as usual in the Trump regime. I think we shouldn't worry too much about much at all, frankly.
It's interesting. Trump gave an interview, quite an in-depth interview with Bloomberg a few days ago, where he said a few things. The one thing is he said he would quite like Jamie Dimon to be his new Treasury Secretary. I don't know if there was a firm offer or just something to throw out to the financial elite, make them feel good about a Trump administration. He also said that he doesn't believe that the Fed Reserve should lower interest rates before the election, as that would be too much interference in the process. And he also said that he would seek to keep Jay Powell on, which is a reversal of his earlier comments. He's obviously playing his book very carefully, and he knows what he's doing.
But just go back to your comment, which he made regarding interest rates. It just says it all. He'd like interest rates to stay high so he can claim when they come down it's all about him. I mean, it shows you how political the management of interest rates in America has become. So I just rest my case on that one. I think it's indicative that, and we just have to be aware that those high interest rates in America have supported the US dollar. As we've said many times before, they're 1.25% above Australia, and Australia's got a higher inflation rate today than America. So, I think we have to be aware that there is political interference in the management of monetary policy in America.
Yeah.
And it'll become more so under a Trump regime.
Yeah. The thing that surprises me is how the American Treasury market has been performing so well. I mean, Trump is not known to be an enemy of high deficits. He's a spender, and yet the Treasury market is performing incredibly well. I think 10-year bond rate in America is about 10 points below Australia at the moment. We're at about 4.3. They're about 4.2. But certainly Trump supports a lower dollar, which could be good for commodity prices. Do you have a thought on that connection?
Well, they're all priced in US dollars, so I guess it's axiomatic if the US dollar falls or declines, then commodity prices go up. But in Australian dollar terms, there won't be much difference. But I go back to your point about Trump. Interest rates, as I said earlier in the earlier question, he'd like to see them lower. He'd like to see the US dollar lower. He has to be very careful in managing inflation. And your commentary about the budget deficit, well, yes, he probably is a deficit junkie, but he's starting with a 7% deficit this time. He's starting with a massive, unbalanced fiscal situation in America. Now, it's going to need more than a Jamie Dimon to fix that one. It'll be quite interesting to see how they do it. Now, their view is obviously that if they whack up tariffs, they can collect the taxes from foreign manufacturers and foreign importers. That may work, but it does add to inflation. So I think the market, to your point about the bond market, is very overly relaxed in terms of the situation for American economic management, and particularly the management of debt. And I think we have to investigate why that long-term bond market is resilient. And the suggestions I'm hearing are that there's not a lot of issuance in that part of the market. So the American Treasury, in terms of rolling over their debt, and let's remember that they've got about $30 trillion of debt. And it wouldn't be hard to imagine $3 or $4 trillion is rolling every year. And if you're running a $2 trillion deficit, you're going to the market to fund $5 or $6 trillion a year from expiring debt and new debt. And if you raise a lot of that debt at the short end of the market, you're creating a risk for the American government, because and maybe that's just gave you the reason why interest rates will come down very quickly next year under a Trump regime, because there'll be a lot of short-term debt, And if they keep on rolling short-term debt, they want to get that interest rate down. Currently, I just don't understand what the strategy is in America in terms of their debt situation, their fiscal situation. It's very, very unclear, Paul. And I think we've just got to watch this space. It'll play out in 2025. But it's a very difficult situation they're managing. But so far, the bond market seems relaxed, and I can't understand why it's so relaxed, frankly.
Mm. You mentioned the fiscal situation. One of Trump's key election promises is to reduce the corporate tax rate from 21 to 20. And in the Bloomberg interview, he even talks about it coming down potentially to 15. I don't know whether that's all talk, but I saw a chart that showed the G20 countries and their corporate tax rates. Australia sits out as a very high taxing country. I think we're at 35 or something. We're about third highest in the world. Is there, if Trump does succeed in getting in and reducing corporate tax rate down to 20%, do you think the pressure will be on Australia to start thinking about a reduction in corporate tax rate?
Well, look, Paul, the pressure should be on Australia. It doesn't need pressure from America. It needs pressure from thought leadership, which we're bereft of. So I'll make that point. I mean, it was reported this week, and something we should cover, that the Treasury updated the FY24 budget outcome, and as predicted, their $9 billion forecast on budget night is now a $14 to $15 billion surplus. So they got it wrong again, and they'll get their FY25 wrong. Australia has plenty of capacity and to adjust corporate tax rates inside a budget surplus situation. I put no credence on their forecast deficit of this year. And Australia's got to start encouraging capital inflows into this country and start encouraging capital investment in this country by adjusting tax rates. We've got plenty of capital available, which is flowing out of the country. We've said this endlessly. Australia is a great creator of capital through superannuation, but a terrible utiliser of capital because its tax regime is so ridiculous. So I take your point, and if Trump leads the way and it rings the bell in Australia, great stuff. But honestly, we should be thinking independently about how we use the capital we have and make sure it's invested in home through appropriate taxation regimes. And we excessively tax capital investment in this country and the returns on capital, where America doesn't. And look at the results. Look at the results. The American corporate sector is much more stronger than the Australian corporate sector, and their diversification in that corporate sector is profoundly different to Australia's. And they encourage entrepreneurs. We don't do that in Australia.
Just like to switch to China for a moment. Obviously, China's the sort of the big enemy in the Trump world, and his selection of J.D. Vance as a vice president certainly enhances that stance, because he's very aggressive towards China. And in the last week, we saw that Chinese growth came in at a disappointing 4.7. That's against their target of 5%. Let's remember that China is by far our biggest trading partner, and more than a third of all our exports go to China. Is this something that you're concerned with, or do you think there's just a little bump in the road and it continues to grow, whether it's 4.7 or 5% makes a little difference?
Well, I just make the point. I mean, it's 4.7% growth. I guess that's not inflation adjusted. I mean, with a very low inflation rate, that's a pretty strong growth rate for an economy which is $16-17 trillion in US in size. Compare that to America's growth of around 2.5% to 3%, which is funded by a 7% deficit, and inflation running above 3%. I mean, is it China's growth is moderating? The use of the word slowing or declining, it's just moderating, as you would expect as that economy grows to the size it is. And I keep on reiterating, it's got the same population effectively as India, and it's 4 times bigger. It's got the population of 4 times bigger than America, and it's 40% smaller. China's growth is going to continue. So is this a blip along the road? I wouldn't call it a blip. I just say it's a moderation of growth along a very long growth profile. and it's not going to stop anytime soon. And 4.7%, I think most of the world would love to get that sort of growth. Love to get that sort of growth. So I think the world growth this year is forecast around 2.75%. So China is growing 2% above the rest of the world. So I'm totally relaxed by it. I'm not concerned by it at all. And I just reiterate, over the last 3 or 4 years, we've had constant commentaries by experts saying China's slow growth is going to affect Australia. Well, it hasn't. It hasn't affected. And our trade with China has never been stronger.
Last question, John, because we're running out of time. And that's about valuations. Markets have had a stellar year. 2 days ago, we hit an all-time record for the ASX 200. So our markets hitting records. On Wall Street, they're hitting records. The rally is broadening from the so-called Magnificent Seven to the rest of the market, to the mid-caps and the small caps. The US markets are up around 17% year to date. Are you concerned with where the markets are in terms of valuations, or do you think that valuations rarely pull markets down? It's something else, and we can carry on performing well till the rest of the year.
Well, we're not looking at a recession anywhere in the world, and the world growth is assured so long as China and India maintain their growth profile. It's about a third of world growth. We keep on saying that. A Trump regime is not going to drive America into recession, so there's the largest economy. So in terms of economic growth worldwide, it supports growth in equity markets and world economic growth and world GDP. So I always keep on saying this, markets always reach new highs. That's just what they do. And that's symptomatic of growth. Am I worried about valuations? Well, I'm watching the bond market. I always watch the bond market because that's your risk-free rate of return. And as we just said, Paul, that bonds are remarkably resilient. They are being dragged lower in actual yield by lower projected inflation. And we saw overnight the ECB saying that the September meeting is open to another interest rate cut in Europe because growth in Europe is fairly moderate. So we're not going to get any issue in terms of what normally upsets markets, which is higher interest rates. That's not on the agenda. Economic growth seems relatively assured from the major economies. I'm never relaxed. That's not our job. Is not to be relaxed. Our job is to look for opportunity and look for excesses. Always in a market like this, which has had a good run, you're going to have excesses in parts of the market, and the job is to look for rotation opportunities. But I maintain you've got to be invested. You've got to be invested in the equity market. You've got to be invested in growth, but never take your cautious hat off. Always be cautious and sensible when you do it. And if we're sensible and cautious, we'll do well.
Wise words, John. Thank you so much. I'll stick my neck out and make a bit of a prediction here that I think that Joe Biden is quite likely to pull out of the race and open up the Democratic convention to someone else to take the reins. I think the Democrats are looking at the Republicans having a clean sweep, and they're getting more and more nervous that they're backing a losing horse. But we'll wait and see. And in the meantime, to everyone out there, we will see you next week.
We will. We'll see whether your prediction's correct.